Hey, good morning, options traders. Happy Monday. I hope everybody had a fabulous weekend. And this video comes to us as a request from one of the traders in our group. And he was asking, can you earn more than the risk-free rate by taking no risk? And it's a really good question, but if you understand some basics of finance, you'll recognize the answer is immediately no. That is not going to happen. So why is that? Well, let's go take a deeper dive, and before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with a quick definition of the risk-free rate. Remember that what this means is that it is free from default risk. Doesn't really mean it's free from all risk. So things in this category, different assets would be things like treasury bills, treasury notes, bonds, some of the, if they're insured, corporate bonds. But these risk-free assets still face what's called inflation risk. So remember, they're not totally risk-free. This is a type of risk that they're not going to be able to keep pace with inflation. So the main thing to get from this slide at this point is that there is really no such thing as a true risk-free asset. But now that we've gotten that out of the way, I think what he's really referring to is that it's free from default risk. All right, so with that definition, let's move on to a quick review of bond yields. This can be a confusing point for people, but remember that there is an inverse relationship between bond prices and their yields. So as the bond prices rise, the yields, or let's call it the interest rate that you're receiving, will fall. So the math can get a little bit tricky, but to make it simple, let's just assume that we have a $1,000 bond. That's the price that you have to pay for it, and it's going to pay its coupon or its interest one time at the end of the year. And I'm doing that just to make the math simple. Most of your bonds will pay semi-annually, every 6 months, but regardless of when they're paid, the math, or at least the concept behind it, is exactly the same. But again, this is just to make it easy. So here's our $1,000 bond, and let's say it's a 5% bond. And what that means is that you're going to receive a $50 coupon every year, which means $50 on your $1,000 investment is 5%. So in today's world, you're not going to receive coupons in the mail. That's typically how they were done eons ago. But this is done electronically. It would automatically land in your brokerage account, but it's still called a coupon payment. So in this case, again, we would say that the yield is calculated by taking that $50 coupon payment divided by the $1,000 price you paid, and that gives you 5%. So we would say the yield on this bond is 5%. So again, that just means you're earning 5% on your money. But now let's say for some reason that bond prices start rising. Maybe there's fear in the markets that the market's going to crash, and investors are now rushing over to bonds for this, what we call flight to safety or flight to quality. And they start bidding up the prices. Hey, I'll give you $1,001 for this bond, or I'll give you $1,005, and so on. And let's say that this bond now rises to a price of $1,010. Well, now what's happened to its yield? Well, now the yield, you're still going to receive the $50 coupon payment. That's the important point to understand. See, a lot of traders think that, well, if the yield has gone up, I'm getting more money, and that's not true. You're getting a $50 coupon payment regardless of how much you pay for the bond. That's in part of what's called the bond's indenture. It's contract. That's the contractual obligation. So back to our market here, let's say that the bond price rises to $1,010. Well, what's happening to the yield now? Well, remember, you're always going to get the 50 bucks, but you paid $1,010 to get that. We divide them out, we see that the yield is 4.95%. So you can see that the price has gone up from 1,000 to 1,010, and the yield has dropped from 5% to 4.95. Let's say that investors start bidding these bonds up even more. The price rises to 1,020 bucks. So again, because the coupon payment stays the same, you're going to receive $50 on a base or a payment of 1,020. So now the yield has dropped to 4.9%. So the main thing to see is that the coupon payment stays the same for any given bond. Again, that's part of its contractual obligation throughout the life of the bond. That never changes. What changes is the price that people are willing to pay for that coupon. And as that price rises, then the effective interest rate that you're earning, or the yield, falls. And of course, the reverse could be true. If the prices of the bond started to fall, then the yields would start to rise. All right, so that's the thing to understand when we're talking about risk-free assets, such as bonds. Now let's take a look at what happens in an active market. The point to remember is that the market will always price all benefits into any asset. So let's just say that our risk-free rate is 5%. But for some reason, we've got this mystery asset out here that also claims to be risk-free that's paying 6%. And that's really what this person's question was: could this happen in a market? That we have these two risk-free assets, one's paying 5% and one's paying 6%. Now again, everything else is the same. They've got to have the same maturities. Everything else is equal. So what we have here is a situation where both of these are risk-free assets, but the 6% asset offers it for a lower price. That's why the yield is higher at 6%. For some reason, you're able to buy this bond for a lower price. Well, the reason that this can't happen, or at least for very long, is that there's what's called an arbitrage opportunity. People will very quickly figure out that if both of these are risk-free, why can't I borrow at 5%, short these bonds, borrow at 5%, and invest it at 6%? Right, so that would be the game to play. Just short the one bond, use those funds to invest in the 6% bond. And that arbitrage means it is free money. So there's absolutely no reason in the world to not do it. So here's what's going to happen graphically. Let's say that this is our 5% bond, maybe a T-bill. And up here again is our mystery asset that for some reason is paying 6%. So what's going to happen is that people will start shorting these T-bills, and they're going to receive money for that, and they're going to invest it into this 6% mystery asset. So what happens to the price of the T-bill? As people are shorting it, the price goes down and the yield, or this interest rate, goes up. And as people are flocking to buy this mystery asset, they're pushing the price higher, and that's going to push this yield lower. What's going to happen is that these yields, these percentages here, are going to start moving closer to each other. So we might see this at some point in the future. As this price gets pushed higher, the yield comes down. As this price gets pushed lower, the yield comes up. Now instead of being a 6% bond and a 5%, it's 5.75 and 5.25. Well, hey, we still have the same opportunity here, not to the same degree, but there's no reason to stop. So people are going to continue selling the T-bills and buying this mystery asset. What's going to happen? Well, those percentages are going to get pushed even closer. And this process just continues on and on as long as there is some type of a discrepancy. And so it will continue until both are exactly equal. And at that point, the free money machine gets turned off, in which case the arbitrage is over, and we now have one interest rate for a risk-free asset. Now you might think, well, hey, wait a minute, in the real world, we don't have that. We've got short-term, intermediate, long-term, and that's true, but those are different maturities. We assume that these are the same. We have different levels of risk going out further in time. But if you keep this process in mind, that markets are going to price all assets according to risk, you're going to find you can prevent some very big warning signs and some traps that you could step into. So for example, if you see an asset that claims to be risk-free, but has a yield greater than the risk-free rate, it's a warning sign. In other words, there's a risk that's not accounted for, but somebody knows it. Market participants are afraid to push that price all the way up to the price of what you're thinking is a risk-free asset, and that's what's causing it to have a higher yield. So here's a very good example, one of my favorite case studies. Many of you might remember this from back in 2008 with the ARSs, the auction rate securities. And what happened back here is that banks had offered long-term maturities, usually 20 and 30 years, with yields that were set by what's called a Dutch auction. The banks had to show up and compete in these auctions. But when the auctions failed, because these were just collapsing with the financial collapse 2007, 2008, then investors were stuck holding long-term investments with no way to escape. And it turns out that many brokers, really almost nearly all of them, were sued heavily for offering these ARSs without disclosing this potential risk. Everybody was selling them as, hey, it's totally risk-free, but you just get a bigger reward. That should be a red flag right there. So astute investors will realize that there's no way or no reason for the ARS market to offer a better rate for taking the same risk. And if those investors had just kept that in mind, they might have been able to avoid this collapse of the auction rate securities. So I hope that helps you to understand that no, all things being equal, you cannot get greater than the risk-free rate by taking no risk. That's also a good point because that's what you find a lot in the options market. People try to box this or spread this off or do this, and they think that they're making it risk-free, and they go, yes, but I'm getting 10%. Well, obviously there's a risk there that you're not accounting for. So if you're making returns greater than the risk-free rate, those are not risk-free investments. That doesn't make them bad. Instead, it means you need to understand that there is a higher level of risk that you're taking. And if you don't know how to mitigate that risk through your hedges, rolls, and morphs, that's where options can help you greatly. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. You can find it all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.